Bhattacharya, senior investment strategist at Standard Chartered. He's joining us right now to take some questions. Rajat, good to have you with us here. Thanks very much. You know, the 4% sell-off in oil that we saw last night, is that good news or bad news? What's your sense?
Yeah, any drawdown in oil is good news in this kind of market, right? So oil is the direct link to inflation, and that is what is on the top of the mind for policymakers. It's also good news for India, for instance, right? I would add that the news from the geopolitical front is not over. We need to watch that. Clearly, global leaders do not want an escalation in the conflict in Israel-Gaza. And that is very clear from the last few weeks. And as a result, oil has pared back. But you do have the conflict still brewing there. So we need to watch that one. But to your point, yes, any pullback in oil is good news in the kind of circumstances.
Okay, any pullback in oil is good news. Rajat, welcome to the show. You know, being an investment strategist, how are you approaching the new calendar year? I mean, 2023 was amazing in all ways, right? For the market, that is. We had a very strong performance. The broader market grew very well in India. Do you think this is a performance that we can replicate in the next calendar year as well? And do you think India will continue to be the preferred pick of most global emerging market watchers?
Yeah, there are two elements there to your question. So the first one is the outlook for 2024. And there we are slightly more cautious because this year, as you say rightly, that the markets have been good, equity markets have been good, but we are heading into this global slowdown. Recession is a tough call to make, but you see, the economy slowing clearly in Europe. They're probably in a recession now, a mild recession though. And US, you saw the job market reports from last week, that continues that trend, downtrend that we've been seeing all through the year. If you extrapolate that downtrend, you'll probably see the US job market actually contracting in the early part of next year, by let's say first quarter of next year. So there is that recession risk overhang in the US. Given that and where bond yields are, it's going to be a tough call for equities to beat bonds in the global scheme of things. Coming to India, it's a different story. It's a structural story, as we've been maintaining. So India is underinvested. That's the first point I'll make in global portfolios. If we talk to our clients around our markets here, and they are by and large underinvested in India. It's a story that is just emerging. People are waking up to it, and that's true for both equities and bonds, by the way. The bond, index inclusion is a key one. So India has, further upside. It's less correlated with other markets. So, yeah, the structural story in India remains intact. Cyclically, I think a more broad-based, diversified portfolio with equal weight towards equities and bonds makes sense right now.
All right. Hi, Rajat. So you're sounding a little bit cautious on global equities, and you, I think, tilt towards bonds rather than equities. But from the equity pack, India is standing out, right? That's the point you're trying to make.
Correct.
And within India, what would you bet on? You have the banking space where earnings have been good, autos, the earnings have been good, and the broader markets as well. Things have looked very, very good. Do you see incremental money flowing to these sectors, or maybe the broader markets as well? Because that's where the big money is being made.
Yes, India is a growth story. So the growth-oriented sectors should continue to do well structurally. I mean, the investment case, the private investment that has picked up over the last decade, let's say, is a big story and a big driver of what's going on in the Indian structural story. So going forward, of course, you have that big election coming up and that political uncertainty comes through as well. But if this private investment pickup, which is backed by government investment has been the trigger, of course, for these private investments, then the growth sectors should do well. Cyclically, though, a more defensive tilt in your portfolios in the very near term should make sense, and that's true for across the board. To your point about the global markets, year-end rally seasonality is pointing towards a year-end rally. But for the S&P 500, that 4,400 is the key to break. We've seen lower lows and lower highs since July in the S&P 500, if you recall.
Sure.
So we need to break that 4,400 to see that year-end rally in the very near term.
All right, we will leave it at that. Rajat, thanks a lot for joining in. Appreciate your thoughts. Let's